In this video, I'll show you how the score in Tykr works. The score is the overall financial strength of a stock, and you can always find the score in the hexagon. So I'll show you 3 examples here, and then we'll dive into how we come up with this score. All right, so the first example would be Nvidia. You can see an 83. The next example is Microsoft is 70. And then the next example here is AMC at a 28. So again, higher the score, the safer the investment. All right, so how do we come up with a high or low score? So if you want to do this manually or kind of visualize it, you can go to the Financials tab, and there are 8 lines we pay attention to. And we have to give a lot of credit here to Warren Buffett, the late Charlie Munger, and Phil Town. So on the 3 financial statements, that income statement, cash flow statement, and balance sheet, we pull those 8 lines. So on the income statement, we look at the revenue, net income, and earnings per share. And we want to see these numbers increasing quarter over 16 quarters. If we can't get 16 quarters, for example, if it's like an IPO stock and we only get 2, that's not enough. So it typically won't show in Tykr. We have to wait for 3 quarters minimum, ideally. All right, so 16 quarters, and we want to see those numbers increasing quarter over quarter. And you can see here, for example, revenue, it's increasing quarter over quarter right in a row with Nvidia. That's exactly what we want. That's actually very hard to do. Same thing with net income. We see here a little pullback, and then we can see here EPS, earnings per share, same thing, a little pullback there. Now, net income and EPS are going to be a very similar story. It's going to look very similar. The difference is EPS is net income divided by outstanding shares. So, all right, that's the income statement. Then we jump over to the cash flow statement. There's one line we look at, which is free cash flow. Similar, we want to see this increasing quarter over quarter. We can see here is doing pretty well, but there's a little pullback. That's part of the reason why Nvidia is not 100 out of 100. And then the last sheet here is the balance sheet. We want to see assets and equity increasing quarter over quarter, and then liabilities and debts decreasing. Biggest liability would be payroll. If it's flat, that's fine. You like a business that's increasing revenue, but keeping its payroll the same. That means it's increasing its profitability. And of course, debts are going to have a lot of bank loans. We want to see businesses paying off their debt. So let's take a closer look here. Assets increasing, liabilities increasing a little, all right, so hiring more people, but I do see a little decrease here, so that's good. And then we see the debt, that's flat, which is totally okay. And then we see equity, and that's increasing. We want to see that increasing quarter over quarter. So again, we have a very rigorous system here, and we're looking at the quarter over quarter, not just the last few quarters, but over 16. That gives us a lot more confidence in the financial strength of a stock. Let's look at another stock here. We took a look at Microsoft, but let's skip that and go right to AMC. This is going to be a different story. Go to financials. Revenues, look at this, completely different. It's like up and down, up and down, up and down. We don't want that. We want to see the revenues increasing consistently. All right, net income, we want to invest in profitable businesses. You can see here, this business isn't even profitable. It's all red. Look at that. Not looking good. EPS will be very similar, just smaller numbers. Yep, same thing, not profitable there. And then we jump to the cash flow statement. We can see free cash flow primarily in the negative. However, the most recent quarter, we did see a nice jump there. And then the last sheet here, yeah, look at that. Assets, we want to see increasing, but it is decreasing. Liabilities, that's decreasing. Okay, they probably don't have much of a choice. Theaters aren't what they used to be. Debts, okay, debts are decreasing. That's good. And then equity, oh gosh, very much in the negative, not looking good there. So hopefully that gives you nice perspective between a really strong business and a really weak business. And of course, again, look for those stocks with higher scores. The higher the score, the safer the investment.